Morning, everyone. Welcome to the Adroit webinar. We will be covering buying a property through a limited company today. Mahim will be here shortly and he will run through all of that. We will be posting everything on social media after this video as well. So if anyone doesn't get a chance to watch it, or if you believe anyone else could benefit from the webinar, please feel free to like and share if you want. It will be on our Facebook, on our LinkedIn, and we will cover everything on here. We will also have an option where you can ask questions also. So please feel free to keep those questions coming. And I will hand over to Mahim in a second.
Should I come there?
Yeah.
All right.
I'm just going to swap over with Mahim.
Hi everyone. I hope everybody is safe. Thank you very much for the introduction. So today's webinar is going to be about buying properties through limited company. It's been a very popular question in the past, especially in the past couple of weeks. And I was speaking to a mortgage broker, and they told me that they had one of the busiest months ever since in the last month. And that kind of shows how popular it is about the property market's been getting very active. So, sorry, one second.
No, you carry on.
All right, okay. So it's fixed. Everything's fixed. All right, that's fine. So this webinar is all about the buying properties for the company. And when you think about buying a property, especially in the current circumstances, the first question kind of pops in: do you want to buy a property through a limited company, or do you want to buy a property personally? And I think that's the first thing that needs to be answered. To give you background, in the last 12 months or 18 months, we've seen a very high increase of interest and registrations of companies for properties. With us in Adroit only, we've registered more than 100 companies, the 100 SPVs, that's what we call it, special purpose vehicle. I'll come to SPV later on at the end of the in the webinar. So we've registered quite a lot of interest, and so that kind of shows the tendency of registering companies to buy the property, and there are good reasons behind it as well. So when you compare buying the property through a limited company or personally, what are the pros and cons? So first of all, and I think the foremost kind of reason why it attracted a lot of interest was interest. Mortgage interest payment is 100% deductible for a limited company, and it's not 100% deductible for individuals. Then corporation tax rate is 19%. So if you're a higher taxpayer, you will, if you're an individual, you'll be paying a lot more higher tax. But if you're a limited company and you do not, wish to extract the funds out, which majority of the time happens with the in the rental business, in that case, you would like to have it in the limited company. And then there are other cons as well for having a property through the limited company. And if you have a property through a limited company, then effectively you can't live in the property. And if you do live in the property, then you have to pay benefit in kind tax. One of the reasons why this, again, there was a lot of interest developed in buying a property through the limited company, it was because a lot of tax breaks that were available for individuals were actually taken away. as most of you would probably know, that if you buy a property individually, then you used to get and if you live in the property at any time during the term of the ownership, then you used to get the main residence relief for the period that you've lived in the property. So let's say you've had a property, you buy a property, you live in for a couple of years, and then you rent it out, and then you sell it after another 6, 7, 8 years. You get used to get a lot of tax breaks. So you get used to get the time you've lived in the property as your main residence relief. You used to get rental relief up to £40,000, and then you used to get 36 months, and then it went to 18 months, and now it's gone to 9 months. So you used to get the tax relief available for buying a property individually, and that is why there was always been the tendency to buy a property personally, because if you buy a property, even if it's a buy-to-let property, at some point you might want to live in the property. We have a few clients who bought investment properties in the city. Now they live in suburbs, big houses, but once they retire, they don't want to live too far away, or they want to just downscale, and they've moved back to the city for whatever reason, and then now that property became their main residence, and they've been living there for, let's say, 4 or 5 years. Now, if they sell the property, it will be they would have got a relief if the relief was available. So, because the reliefs were taken away, and you get something extra in the limited company, that's why the limited company has been extremely popular. Also, from IHT purposes, now IHT is a very complex subject, but just to give you an idea, for IHT is inheritance tax. So if something happens to you and you want to pass the property on to your kids, you have to pay IHT. And I don't go into the details of the limits and etc., but yeah, limits and limits combined together for the couple. And then if you have wealth more than that, you have to pay 40%. And a lot of our clients, especially high net worth individual clients who have multiple properties, don't want to actually gift some of the business or some of the properties away, but do not want to hand over the control. And for that, from IHT perspective, and for them, a limited company becomes a really good way out of it. So they can give their kids 49% shares of the company. They keep 51%. Now they've given 49% of the properties effectively. And if they survive 7 years, then it'll be a pet, which is potentially can transfer. They don't have to pay any IHT on the 49%. But they have kept the control. So none of the kids can start and say, I want to sell this property, it's mine. No, they keep the control, the dividend income split, and they have the control, and they've given the shares in the property. So that was really popular, and still very is. So that's the kind of background of buying a property through the limited company. Now, one of the questions was, what expenses can I claim? Again, while we're talking about it, I'm just going to do a very quick comparison between a limited company and individual. The expenses are pretty much the same, wholly exclusively and necessarily for the purpose of the business. So any expense you do for rental purposes is allowable as an expense. One of the key things that we need always to look at when we are recognizing an expense is revenue versus capital. So if it's a revenue expense, it's an allowable expense as a deduction against the income. If it's a capital expenditure, then it is not allowable as against rental income, but it comes as a capital expenditure, i.e. when you sell the house, that's when it is deducted from the profit, or to calculate the profit. And then you pay tax on it. So expenses are very generic. You have maintenance, agent fee, any expense you do to look after the property. What you can't do is, and this question got asked a few times last week as well, can I expense my time? Well, you can't expense your time but you can pay yourself salary. So if you can say, look, I'm looking after the company properties, after property portfolio, I will pay myself salary. So that's fine. And if you do, and if you hire a tax expert, just remember that while the company is getting a tax relief against the rental income, you still have to pay personal tax on it. So expenses are very similar for individual and the limited company, and that'll just go down on whatever expense you do for the rental business. And if you have 2 or 3 properties, then it's all combined together. So you can it's all grouped together as one. So if you have one property which is making a profit, one property which is making a loss, it is grouped together as net of with each other. Can we put again, as this was a question asked, so I'm just trying to go through the order of the questions as well. Can we put someone as an employee of the company? Yes, as long as we can justify that there was some work being done by that employee, i.e., so if you have multiple properties and you want to hire someone to look after them rather than having an agent, absolutely fine. You need to be able to justify the kind of work they're doing and the salary that you're paying for them, but there's nothing wrong in having an employee of the company. Now, let's come to CGT, or the tax. Now, the tax, again, I'll compare against individual and limited company. As an individual, if you have a property and if you sell the property, if you basically taxpayer, it's 18%, and if you hire a taxpayer, it's 28% tax. As a limited company, there's no capital gains. It's actually a corporation tax rate, which is 19%. So if your plan is to either keep the property going, or if you want to sell one property and buy another one, then obviously the limited company is going to be cheaper because you're going to take corporation tax, and which is 19%, rather instead of 28% if you're higher tax bill. And so that's kind of a very decision-making factor of what you really want to do with the property portfolio. Do you want to extract the cash out, or you want to retain the funds? Again, if you are a high rate taxpayer and you want to extract the maximum cash out of the rental business, so i.e., you're rent you've got a 350, 400,000 pound property, giving you rent of, let's say, 1,500 pounds, your rental, your mortgage payment will be probably 600 pounds. So you get about £1,000 a month extra, which you can extract out. Now, you can either use the same funds to keep it savings and buy another property, or pay the capital, or use some of the funds for the maintenance purposes. But if you want to extract all the funds out of the business, or from if you're holding individually, then limited company, and then depending a high rate taxpayer or basic rate taxpayer. So if you're a high rate taxpayer, you want to extract the funds out, you'll pay 19% corporation tax, and then when you extract the funds out, you'll pay 32.5% tax on dividends. Whereas individuals, you're only going to pay 40%. So you're going to pay more tax if you have a limited company. Then, but if your plan is to either keep investing and buying it more, or pay the capital off, which is kind of the most favorable option in case of you not your sole dependent business, then again, limited company works out a lot cheaper because you're only going to pay 19% corporation tax, and then you have the funds so you can use it for future. Sorry. One of the other things that we got asked about was about stamp duty, and how it differs and what happens with it. One second. So how does it differs from making difference for the individual or the limited company? What are the planning bits? on it. Now, buying a property through a limited company, the stamp duty calculation is on the property. So on a standalone, the stamp duty will remain exactly the same. Will be paid by the company. It will be a company expense. So you'll have to fund the company so the company can pay for the stamp duty, and will pretty much be the same if you buy it personally. What a lot of planning we've seen in the last 1 year, where people were buying a second home, which was a lot more expensive than their first home. So we had a client who had a first home for £300,000, and he was moving on to a bigger property for £1 million. Now, if he buys the second property, the second property will be 1 million, and he'll pay extra stamp duty charge of 3% on the top of what should be the stamp duty. So in that case, what our client did was he transferred the first property into a limited company. He bought the first property, second property, and then he transferred his first property into a limited company. Now the first property became the second property, and the stamp duty extra 3% was paid on £300,000 instead of the £1 million, and he was able to save stamp duty charge on it. Again, we are not stamp duty specialists, so we'll have to consult further on them with the specialist. But just to give you an idea what that's kind of planning that was done involving limited companies holding properties. One of the things which is very kind of unique as well, or interesting from the stamp duty perspective, is the stamp duty on a limited company shares and stamp duty on buying and purchase of a property are very different. So if you sell a limited company, for example, if you have a property through a limited company, let's say you have only one. I've got a client who's got like 5 properties through 5 different limited companies, and he's done it like this ever since he started buying the property. So each time he buy a new property, he buys through a different limited company. Now, if he sells the limited company, the stamp duty is paid on the shares transfer, which is I think 0.5%. So the stamp duty difference could be huge if you're selling the shares of a limited company on the property or individually. So that's really handy to know. Generally, people don't tend to buy the shares of a company just to avoid any legalities or liabilities that comes along with it. So if you buy shares of a company and the company had any liability or anything outstanding debt, then it becomes your problem. So you have to be very careful. Now, regarding setting up a limited company, why we talk about SPV, the first thing that I said to you guys. So SPV, what is SPV? A special purpose vehicle. Is it any different from any other limited company? No. It is just a standard company, but in the CIC codes, the company house, the codes that we declare in the company house, we just select a certain specific codes to make it a property management company. And not that it makes a huge difference from the accounting perspective, but the banks really look after that. Now, I don't know much about it. It's just the mortgage brokers that we've spoken to always come back and say, we would like we want to have, the banks are looking at the property to be an SPV. Converting any company into an SPV is no problem. You know, you can convert the shares, change the CIC code into SPV. Again, we need to get, if any questions, then we can need to go back to the broker or the lender about their requirements on it. Now, the first thing I said again, the mortgage broker that we spoke to said that it's been a very busy month for them, and why is this happening? In my view, this is happening because for two reasons. Firstly, because we've seen the property market prices are slashed a bit, and it has been reduced. So it seems like a good negotiating point for the buyers, because it is going to be, it has been a bit tough, and with so many businesses being closed and jobs being lost. So it is really a concerning point for people who are selling the properties right now, and they want to make sure that they can just sell it off as quickly as possible. So that's a good negotiation. You know, you're getting good deals right now, and then people want to, especially the investors, long-term investors, want to get on with it. Secondly, we've heard this, that a lot of people are buying it because they've got now loans from the government, so that they have the funds and they want to invest into properties. And I think that's the two key reasons why we've seen a big rise in seeing the mortgage book getting busier. So what if you have your limited company, and let's say, I'll now be more specific to most of our clients, which are consultant contractors. They have the companies, they're running it, they have they've got a profit of, let's say, 60 or 70K, or they have, it doesn't matter about the profit, it's just matter about the cash in the business. So they've got 100K sitting in their business, and they're saying, hang on a minute, we just would like to invest this business money into a limited company. Now, into buying a property. But first suggestion always is, if you want to buy a property through a limited company, set up a separate company. And why? Just going to be very simple, not going into the details. It's simple because if you buy a property through a limited company, it will become, it might become making your consulting company an investment company. If it's an investment company, if there's an implication of IST and there are other implications. So to avoid all of that, we suggest to have a limited company separate for the property. Also, a lot of contractors and consultants, especially because the I-35, they're closing down the companies. And so in future, if you don't have a contract, you want to close the company down. If you have a property through the company, you probably will, unless you dispose of the property, you won't be able to do that. So that's where it's always advisable to keep the consulting contracting company separate from the property company. Now, so you've got 100K in your consulting company, and you want to buy a property. Now you have two options. You can either take the funds 100K out as dividends, and then assuming you're a higher taxpayer, you pay 32.5% tax on it, and then you can go and invest the remaining of the funds into your limited company and buy a property through that. That's one option. The other option is you can open another company and invest 100K, or not invest, actually you can do invest. You can loan 100K to your property management property company, and then from that you can buy a property. And in response, in part of that, you can even have an agreement between two companies where you can have an interest being charged. So for your property company, it will become expense. For your consulting company, it'll become an income, and it'll be good use of the funds that are in the company. Not doing, because the bank rate on interest is pretty much nothing. So you can charge, let's say, 2% or 3%. I think 2% is good enough. Whereas sitting in the bank won't even pay you 0.5%. So it makes more sense, and it's justifiable as well that you've invested this money into a property management company and the property being bad. And then if you do this, you don't have to pay the dividend tax charge on it. What if you've got, you don't have profits, but you have, you don't have profits, but you have cash in the bank. Now, if you don't have profit in the company, you do have cash, it is mainly because that cash is about tax. Either it's because of that, or either it's because you have taken loan. So keeping the first bit out, so let's say you have tax and you're going to pay tax, you're going to use the money to pay the tax, so you're not going to touch the tax money. So let's say you have a consulting company which has been running for, let's say, 5 years, 6 years, 7 years. It's a good history. you go get a business loan for, let's say, 50K on that company. Now, you've got this loan, and then you would like to invest that money into a limited company. Now, if you if you take this money out of the company and give yourself a loan, then there are tax implications of that. And the implication is that if the loan is more than 10K, then you have to pay benefit in kind tax charge on it. And if the loan is outstanding, it doesn't matter how much, even if it's 3K. But if the loan is outstanding 9 months after the company year end, then you pay 32.5% refundable charge. So refundable charge in the sense that when you return back the loan, you will get this money back. So if you do it, if you're buying the property personally and you have the loan money, then you can, when you extract the loan, you have to remember that you have to pay the money back within a certain period of time to make sure you don't pay tax. Now, there's a lot of tax planning involved here, and that can be done very easily. So, for example, if your company year end is, let's say, July, and you want to take a loan and take the loan out, then we can change and let's say you've taken a loan in July and taken the money out in July, so you can change the company year end to June. So July will fall under the next tax year, and in that case, you will have a lot longer period to pay the tax on it, or a long period to return the funds back. Or you can loan this money from one company to the other, go through the same process. Then comes, what if you want to close one company, but the loan hasn't been paid back? So, for example, like you have your consulting company gives loan of 50K to your property company. A year down the road, you want to close consulting company because you have stopped contracting or doing the consultancy work or whatever reason. It could be, or you want to retire. Now, the property company has to return back the loan to the consulting company, but the property company do not have funds because the property company used all the funds to buy the property, and the excess that you generated, you've kind of either spent or you have you've paid the capital off, so you don't really have the funds to pay back your consulting company. In that case, there are a few options for us. We can either transfer the debt to the owners in dividend species. I don't want to go into detailed complications of that, but that can be transferred to the owners of the company in the form of dividends, or to the shareholders, or you'll have to write off the debt. So but because these two are connected companies, if they are connected companies, you won't get tax relief on the write-off of the debt. So if the property company can't give the debt money back, then that's how it can be done. I think that's kind of in overall view of the buying the property through the company. We've gone through quite a bit. And I would have seen that some of the questions being asked as well. So let's have a look. So Avais has asked a question: what are the tax implications for the company that lends the loan? I think I've kind of answered that already. So the company that lends the money needs to just charge, as I said earlier. It'll be nice practice to have an agreed policy of charging an interest to the property management company. So the property management company, it becomes an expense. The company which is lending the money will become an income. It just makes it more viable, justifiable, because if you have funds sitting in the bank account, you will not be able to earn that much interest from the money sitting in the bank. So it makes more sense. What about the loan between two companies? Would that be no? The loan between two companies is not affected by the 9-month rule. That is only for closed companies. Company which has 5 directors, or if all the directors are the shareholders. So it's not going to have any impact on the one company giving the loan to the other one. All right. So have we got anything? Questions? Any other bits?
No, I think that is it.
Oh yeah, we've got a few more.
Yeah.
What would be the process looks like if you had bought a property a few months ago as an individual, now wanted to start a limited company and transfer the property? Okay, so if you have bought a limited property through limited individually, obviously you've paid the stamp duty and all the expenses. Now, when you transfer the property into a limited company, you will have to pay the stamp duty again. So that is why when you have, if you have a property owned individually yourself, it's not always the best option to transfer the property into a limited company. You have to just go through the pros and cons, why you want to do it. I did a planning for a client many years ago who had about 10-15 properties, and we were focusing mainly on the IHT, and as I said earlier, that the client wanted to give away the property ownership bit, but not wanted to give the control to the, sorry, what's happening? It's okay. If you do not want to give the control to the kids, so we went through a limited company route. We transfer the properties into the limited company, and we did a pros and cons calculations, cost benefit analysis. The IHT for that client was, in few millions. So he did spend about $500,000 in transferring it, but he was able to save millions from on IHT perspective, and that's what it was the focus on that. Do you have a specific company set up for property management, or can you buy property or just a regular company that can have a business trade? I think I've already answered this question. Banks require, mortgage lenders require the company to be an SPV. What is SPV? It's a company which is have certain codes on the company house. I think that's as simple as that. The company is exactly the same as any other company and doesn't make any difference at all. So, that's used just for business purposes. I've got another question from Leah. Do you have a specific company set up for property management? Oh, we've got the same question. I think that's pretty much it. We have no further questions from anyone, or have you got any other questions coming in?
No, we haven't got any other questions coming in. If anyone does have any other questions, actually no, I'm lying. There's one question that's just come in.
If you transfer first house to a limited company, what is the stamp duty on the second property? Is it like first time buyer? Yeah, so I think we were doing it, I was explaining the tax planning part of it. So if you have, so let's say, again, I'll give you an example again. You have first property for 300,000, your second property is, let's say, 700,000. I'm not going to do the calculations here in detail, but I'm just going to give you an idea. So if you want to, if you buy the second property and then transfer the first property into a limited company, then effectively your first property becomes the second property. So the extra 3% charge is paid on the second property. The extra 3% charge is paid on the first property, or actually the second property, which is going to be more expensive property. I do want to say one thing here. This planning is slightly out of date because HMRC changed, waived off the stamp duty for up to, I think, 500,000 was that?
Yeah.
And what I've been told by the brokers and the information I've got is the 3% extra charge still applies. So if you have a first property for, let's say, 200,000 and you've got a second property for 500,000, the normal stamp duty is gone, but the 3% additional charge is still there. So you pay the 3% extra, but not the actual stamp duty that should have been paid if in the normal circumstances. Anyone else got anything else before we sign off? That's it, guys. Thank you. Oh, sorry. What is it? Okay. Thank you very much. Has, do you want to take it from here?
Yeah. So I'll just move this back around to me. So we will post this up on our socials, as I said earlier as well. If anyone does have any further questions, please just drop us an email to inquiries@adroitaccountax.com. And we will also be running another webinar next month on Wednesday, the 26th of August. Same time will be at 11 o'clock. And we will be covering leasing a car through a limited company, the benefit in kind, tax and VAT implications on that. So if you would like to join, I will send out the emails as I did this time, and we will see you again. Thank you. Bye.